Welcome to the last of our 3 videos examining financial statements. Here we look at the statement of cash flows, which is a key document which shows us where the cash has been spent and where our cash has come from. It has 3 component parts. We look at operating activities, financing activities and investing activities. Because of the simplicity of the case study, Chain in Gear, where focus is much more on operating activities to demonstrate to you the transactions as they occur in each of the methods used. The 2 methods are the direct method, which shows us the change in cash from our opening and closing period, and then we look at the indirect method, which is a reconciliation between the profit from our income statement and the cash that's shown in our statement of financial position. As with each of our early videos, we started with our accounts worksheet. Here we have the accounts worksheet completed for the month of June. And you'll notice that we brought forward the balances for May from the previous video, and this includes the retained earnings figure, which is made up of the loss for the month of May plus the brought forward balance from April. So our retained cumulative figure is 213. You may recall that our equipment was after charging depreciation of £25, and each of the other balances have been brought forward from the month of May. We are also going to examine or transfer the figures across to our income statement, so we'll see where those figures are taken across to. And as before, we're going to look at the cumulative balances which are transferred to the statement of financial position. However, the key part of this video emphasizes the change in cash for from the close at May to the end of our period in June. So really the focus in this video is much more about our cash as opposed to our profit in our income statement or the statement of financial position. If we now transfer the data from our profit for the period into the income statement, you'll see that we have our profit figure of £935. And the key thing from our perspective for this video is that the profit will not equal the same figure as the cash. And one of the purposes of our statements is to demonstrate why or what is the difference between our profit and our cash figure. You'll also see in our statement of financial position that our profit figure of 935 has been brought forward from the income statement, and we have a closing figure for cash of £17,623. So there's a significant difference now between our cash figure and our profit figure of 935. We're now going to examine 2 financial statements that will be able to help us examine cash and the cash movement. First of all, we're going to look at the direct method of the statement of cash flows, and here we're examining the movement from the opening cash position compared to the closing cash position. And to do so, we have an extract here from the accounts worksheet that we just completed for the month of June. So we have our opening cash balance of 17,288 and the closing figure of 17,623. This is taken directly from the accounts worksheet. We can now compile our direct method of cash for those 2 months and actually post the relevant figures that we have. So we have £1,500 of cash receipts from our customers, which we have over here on the right hand side from the extract from the worksheet. We also have paid £1,000 to employees, taken from the accounts worksheet, and we have cash paid for other operating expenses of £180, which is made up of our utility bill and our bank charges. We also have interest received of £15, again picked up from our worksheet, which we placed. There was no interest paid in this particular instance, so the net cash generated from operating activities is £335, which is represented by the change in our opening cash and our closing cash. So this is quite a straightforward exercise to examine the direct method, and it really is an analysis of transactions from our cash records. This is quite different in approach to our indirect method, which begins with an examination of the profit for the period, and in this case we started with £935 of profit before tax. Now, not all of this profit will have involved the movement of cash, and the statement of cash flows reconciles the profits from the income statement with the records that are kept for cash in the statement of financial position. The first thing we're going to do is adjust for interest receivable or expensed in the recorded in the month of June, to get back to our operating profit. Effectively, we're moving back up our income statement here, and we're going to also adjust for the depreciation. So we're going to add back our £25 depreciation, and we then get to our operating cash before changes in working capital of £975. Just so we're clear what that where we've got these figures from, if we return back to the income statement, you'll notice here we have the profit before tax of 935. Then we've adjusted for the finance income to bring us up to our operating profit, and then we've adjusted this figure for depreciation of £25. Effectively, we're working our way back up the income statement and making adjustments as we move along. Now we have our operating cash before changes in working capital, but we do need to adjust this figure for these movements. And you'll notice that we have changes in inventory, receivables and payables are key areas here to adjust for. Again, to demonstrate where these figures have come from, if we return back to the worksheet and examine the changes in our inventory, our receivables and our payables, we can see that the opening balance for inventory was 750, the closing balance was 8310, and the change is 7560. The same with our receivables. The opening balance from our worksheet was 5,000, the closing balance was 12,100. That's a change of 7,100. With the payables, we have a figure of £14,035 after the change from May to June. We can now enter those figures into our indirect method, So we have 756 over inventory, 7,100 for receivables, £14,035 for payables. Notice the signs we have here that if there is an increase in our inventory, as we had from our worksheet, is actually to adjust for the profits here to get back to our cash. We actually deduct the figure. It's almost counterintuitive here, but we do the opposite. So we do the same for our receivables and add back our payables figure. So we now have cash generated from operations of £350, which we make an adjustment here for our interest receivable will bring us to the correct £320, and then we adjust back for our actual interest received of £15 to get to our net cash generated from operating activities of 335, which is the net change in cash at the opening period and the cash at the closing period. So this is a very different exercise in the indirect method. We're starting with the profit before tax from the income statement, and then we're adjusting for entries to get to our operating cash before changes in working capital, and then we make adjustments for changes in working capital before we get to our cash generated from operations, and then finally our net cash generated from operating activities. Ultimately, this represents the change in the opening and closing cash position. To summarize our three videos, the statement of financial position provides the financial position of the business at a point in time. So in this video we looked at both May and June as the two position audits, if you like, which enabled us to establish the performance of the business in the income statement. Likewise, we've been able to examine the cash change from May to June using two statement of financial positions, and this has given us our statement of cash flows using both the direct and the indirect method.